Friday, August 19th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at why I think a UK sovereign debt crisis could be imminent, and it will be much more than just a currency or sterling crisis. And I would say it's not going to be just the UK, but I think it's going to start here. It will spread, of course, to the Eurozone, the countries that use the euro, and eventually America will have its own crisis. For now, the dollar will stay pretty strong, of course. What I'm going to do is I'm going to reference some personal experience and a couple of books and some of the headlines that I've seen to try to show that things don't look great. And I'll also look at some charts today. So personal experience, when I moved to the UK or to England back in 92, before I moved, I negotiated with my future employer from Switzerland on a salary that measured equally to my salary in Switzerland, and I used the sterling Swiss exchange rate, GBP CHF. And I'd started working in Switzerland in finance back in the late 80s, and I worked there for almost 3 years for a small private bank in Geneva, Switzerland. So at the time, £1 bought about 2.8 Swiss francs. So I negotiated my salary. It was fair. And I arrived in the UK on the bank holiday, September bank holiday, on that weekend. And I started work on the Tuesday. Monday was a holiday. And a few weeks later, the pound drops out of bed from 2.8 to 2.4 versus the Swiss franc. And for the first time in my adult life, I realized, well, exchange rates are important. Of course, Mr. Soros made $1 billion on that crisis, on the back of that crisis, the crisis in which he supposedly broke the Bank of England. So that was my first experience. And now I want to reference this book here, The Triumph of Gold by Dr. Franz Pick. And I'm going to go to the introduction because it's very interesting what they talk about here. And this is by Dr. Henry Jarecki, who was a friend at Franz Pick. So this is what he says on page 2. Pick told me, the most important prediction I made was very romantic. In August 1931, my new wife, Peggy, and I lived in Paris. That summer, she went to Bohemia to visit my parents, and knowing she would be gone for a month, I went sailing. I sailed from Holgate, the small French village where William of Normandy first gathered with 15 men who went with him to Hastings in 1066, to England. So he sailed to England. But when I arrived there in the small town of Cowes, that's in the Isle of Wight, to be exact, I found so many other boats there that I could not moor. Small boats, one after the other, were bringing sailors to shore from nearby battleships. I asked one of the sailors, why? He said, young men, we're going on strike. Why? I asked. For higher pay, he said. Knapp, that's his economics professor from university. It says, Knapp had taught me that currencies fall when there is a rupture in the state, and I thought striking sailors were a manifestation of such disorder. I concluded that the currency had to fall, and so I ran to the telephone and called the Czech financier Pick to tell him to sell the pound sterling short. That was on August 10th, 1931. Pick sold £1 million short, half to the Czech National Bank and half to Kleinwerts in London. On Yom Kippur, which happened that year, at the equinox. On September 21st, 1931, sterling was devalued and Pick made $1 million. And apparently Jarecki asked him, why do you mention the equinox? Well, apparently he had a theory that devaluations happened on the equinox for some reason. And the reason I brought that up is because the sterling crisis of 1931 was in the equinox, and the Soros sterling crisis of 92 was around the same time, because it was around the third week of September, and I remember it vividly. And here we are in August, and sterling is not looking good, and there's all kinds of headlines out there. There's all kinds of strikes, as you can see. I'm not sure the sailors from the Royal Navy are striking, but it's serious. The economy is coming to a halt. We've got consumer confidence hitting record lows here as household mood darkens, according to the FT. And on the political side, I would say that what's going on now in the Conservative Party, and the fact that a new prime minister is going to be in office on September 6th, I think. There's a change of the guard. There's a change of the guard in the beginning of 2020. As it regards to the Bank of England, Mark Carney left just before everything kicked the fan. So his legacy was kind of protected. But if you look back, Mark Carney and Mervyn King, they all kept rates very low for a very long time. And unfortunately, Andrew Bailey now, and I'm not defending him, he's going to get all the blame. So you kind of wonder if the next prime minister, be it Truss or Sunak, yeah, they could probably get the blame for this, and Boris Johnson will just go away and look, sit down with his popcorn and watch the crisis unravel. And the other symptom, more to do with the social aspect, and this. And in this example, I'm going to reference this book, which you're probably tired of seeing now, When Money Dies, The Nightmare of the Weimar Hyperinflation by Adam Ferguson. He talks about how young women from respectable families had to resort to prostitution to survive because normal work didn't really pay. And yesterday I saw this story in the Daily Mail, exclusive. Rising number of NHS staff and carers ditch frontline jobs to become adult entertainers on OnlyFans, where they can make up to £50,000 a month amid cost of living crisis and government pay row. So there's another symptom there. In my opinion, doesn't bode well. So I wanted to show you a few charts. The first one is a very long-term chart of the 10-year gilt yield. The gilt is the equivalent of a treasury bond or note for the UK. It's the UK government debt. And we've had like a bull market in the price of gilts, just like in treasuries. So yields have been dropping for the last 40 years, as you can see here. But now they're starting to pick up. And we've broken this first line here. We've broken through that trend line decisively. It's from the high back in around the mid-90s. And then there's another line going back to the early 80s when the 10-year gilt yield topped above 15%. And we're pretty close to that. I would say right now it's around 2.7. 3 would definitely get it above there. And you can see the gilt yield is at around 232. That was as of yesterday. So this means that financing costs for the government are going through the roof while the economy slows down. You saw consumer confidence at all-time lows. We've got strikes, and the economy, in my opinion, is already in a recession. And that's not good for government finances, of course. And then I wanted to show you this chart here. It goes back, let's see, to the late 90s, just to show you that since the late 90s up until recently, it didn't matter really that much what the currency did. If sterling went up or the dollar went up and down, yields continue to go lower, the UK gilt yield. So what I have here, the blue line is the gilt yield, as you've seen, and it's earlier in that longer term chart. And as you can see, we've risen almost from zero back in 2020 to now 232, 233. And you can see that earlier this year we went up to 2.5, dropped back down, and now it's picking up again. And the other chart is actually, it's not GBP USD or cable rate, it's a USD GBP. So it's how many pounds $1 can buy. So this way you can see that it's a chart that's going up, and this actually shows sterling weakness because it's a strength of the dollar. So as you can see here, since I would say towards the end of 2020, beginning of 21, we're seeing yields go up, and we're also seeing the dollar go up. And if you look at the 08 crisis, we saw a big drop in yields at that time and a big rise in the dollar. So it wasn't really, yields were not really going up when the dollar went up, and that was okay. That kept the government going because they kept their cost of financing low. But now it looks like it's the worst of both worlds. You have a falling currency and rising yields, and to me it seems like foreign investors are bailing out of the UK, and selling gilts or selling sterling is a reflection of that. And so I've got another chart here. This is even more short term. It goes back a few years to around 2018, and you can see clearly here that the strength of the dollar is matching rising yields, and that means that gilt prices are going down and their yields are going up, and interest rates are going to go a lot higher. And you can see that line up on the top there. That's that long-term trend line I talked about from the first chart. So we're getting very close to that level. If we go above 2.7, I think everything could kick off. And we're very close to September and the equinox. Well, that's in about a month's time, I would say. I don't know exactly what day of September that will be around 22nd or so. And Yom Kippur as well is around that same time. So it all looks very interesting. And what could be the consequence of such a crisis? What if we see the dollar continue to rise against sterling? Right now, you can see that the dollar has gone from like 70 in the middle of 2021, and we're now around 83. So that means $1 is buying 83 pence. It was only buying 70. I think we could go to 1-to-1, and we could see actually a lot of selling in the sovereign debt market or the gilt market, and that could push the Bank of England to raise its base rate aggressively to defend the pound. And if they don't do that, we could see a real collapse of the whole currency and also the government debt, and that will trigger a massive recession or even depression, I would say, for the next 12 months or maybe even more. So that's why I think the signs are not good. Am I saying this is going to definitely happen? No, but I think it's a major possibility. And I feel quite comfortable having my precious metals, my gold and silver. You can see that in sterling, the price of gold has done quite well in the last year. Maybe not so in the dollar, but as I said earlier, this is going to be a world sovereign debt crisis, and it's going to be reflected in weaker currencies versus the dollar, and eventually the dollar is going to go the same way, and it will be reflected through higher gold and silver prices. because when the Bretton Woods system was set up in 1944, the dollar was the base of the system, and the dollar was measured in troy ounces, $35 per troy ounce. And all the other currencies were measured in dollars, so indirectly to gold. So gold is the ultimate base here of the system. And only when the dollar starts really, well, when the dollar or gold starts going up, or the dollar starts crashing against gold, is when the system is really like on its last legs. And I think we're just in the beginning. And I think the UK might be the first domino. The euro and the European Union will not be far behind, I don't think. So with that, let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. We've got spot gold at 1754 is down about $4. Silver is down 26 cents or 1.3%. 1927. High's been 60, low has been 26, so we're near the lows. To the stock market, the Dow futures is down 113 or 1/3%. NASDAQ 100 futures down 73 or 0.5%. S&P 500 is down 20 or 0.5% as well. FTSE is down slightly, so is the Euro Stoxx 50. Not much to write home about there. In terms of the currencies this morning, sterling got hit hard yesterday. I think it dropped 1%. And I think, as I said earlier, I think it's going to continue to drop. Right now, it's down only slightly at 119.18. The euro is actually below 101, so it's almost at parity versus the dollar. This is not historically the lowest rate for the euro. I think we got down to 82 cents about 20 years ago or so, maybe a little more, euro versus the dollar. The dollar is up 0.5% versus the yen at 136.50. Dollar is up about 0.2 versus the Swiss franc at 95.80. And the dollar is up 0.2 versus the yuan at 681.60. The dollar is down 0.5% versus the ruble at 59.60. Aussie dollar is unchanged at 69.15. The dollar's up 0.2 versus the Canadian at 129.69, and the Kiwi dollar is down 1/3 at 62.36. To the general commodities, we got WTI crude down 1% at 89. Brent crude is down 1% as well at just around 95. High-grade copper is down slightly at 363. U.S. nat gas is down 1.2% at 907. The TTF Dutch nat gas future is down 1.6% at 237. Let's quickly look at the Treasury yield curve. We'll start with the 2-year yield. That's at 327, up 3.5 basis points overnight. The 10-year is at 294, up about 5 basis points. So the yield curve is inverted still by 34 basis points. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel as well if you haven't yet. And with that, I wish you all a great day and a great weekend. Take care. Bye.